Retail investors, wake up. If you're holding leveraged positions, high-risk assets, or even safe stocks, you are standing on the edge of a liquidity cliff, and the ground beneath you is starting to crumble. Tonight, I'm going to show you exactly why the system is about to implode, why retail investors are going to feel the brunt of the pain, and most importantly, what you can do before it's too late. This is not a prediction. It's math. It's real-time market mechanics. And the countdown has already begun. Let's start with the engine of the crisis. Liquidity is vanishing from the markets at a pace that's shocking even to seasoned traders. Banks are tightening lending, bond yields are spiking, and margin calls are piling up faster than anyone expected. Shadow banks, small regional institutions, and even some major funds are scrambling to secure cash, while retail investors remain oblivious, convinced that the party will never end. Meanwhile, the faucet of new liquidity is barely running. Every day that passes, the system becomes more fragile, and every day that passes, your risk grows exponentially. This is not theory. It's happening right now. When the bond market starts screaming, when yields rise faster than central banks can respond, the cracks appear first in the leveraged positions held by retail investors. You see, institutions have access to emergency liquidity. They have relationships with central banks, they can short markets, they can hedge, and they can survive a temporary liquidity drought. You, most retail investors, cannot. Your positions are over-leveraged, your margin calls are automatic, and your panic selling is the fuel that drives the next phase of the collapse. Let me make this simple. Imagine a bathtub. The water represents liquidity. Banks and large institutions are standing around the tub with buckets. They are removing water faster than the faucet can fill it. You, the retail investor, are swimming in that water. You can see the level dropping, but you're too late to climb out safely. Every asset you thought was safe, stocks, ETFs, crypto, becomes a wave ready to wash you out. And when the system cracks, it's not going to discriminate. It will take everyone in its path, but the retail investors, unprepared, are always the first to get crushed. Let's zoom in on the mechanics. Margin debt has reached levels that are historically dangerous. People have borrowed aggressively to chase gains in equities, crypto, and derivatives. When prices start falling, even by 10 to 15% overnight, margin calls hit. Brokers force liquidation to protect themselves. Prices drop further. This triggers additional margin calls. You're in a domino effect, where each forced sale pulls the rest of the market down. And yes, the media will try to convince you it's just a correction, but corrections don't usually happen this fast or this violently. And here's the kicker. The Federal Reserve, which used to act as a backstop, is trapped. Interest rates are already high. Inflation is rising. The Fed cannot inject liquidity at the scale required without triggering a massive currency problem. The dollar is already under pressure. Printing trillions more dollars would further devalue the currency, but doing nothing means letting the system crack. This is why the Fed put. The idea that central banks will always save markets is gone, at least for retail investors in high-risk positions. Now, consider the bond market, the largest and most important market in the world. It controls liquidity, interest rates, and the health of banks. When yields rise, bonds crash. Banks hold bonds as collateral. When the value of that collateral falls, banks become insolvent. This is not theoretical. We saw it in 2023 with regional banks. And every time it happens, it's retail investors who feel it first, because the institutions are hedged, prepared, and ready to buy assets at fire sale prices while you are forced to sell. Let's talk about timing. The early warning signs are already visible. Watch the yields on U.S. Treasuries. Watch the spreads between corporate bonds and government bonds. Watch margin debt reports. Watch redemption flows in ETFs and mutual funds. If you see unusual spikes, redemptions, or banks tightening access to cash, these are signals that the liquidity tap is running dry. And here's the brutal truth. By the time the media starts screaming about it, the worst may already be happening. Retail investors are in a perfect storm. Over-leveraged positions, lack of access to emergency liquidity, and emotional trading habits. The system is set up in such a way that your forced selling accelerates the collapse. Meanwhile, the institutional players are positioning themselves to profit. They are effectively waiting for retail investors to provide them with assets at massive discounts. It's not personal, it's math. The system favors preparation, balance sheets, and access to liquidity, none of which most retail investors have right now. And don't underestimate the psychological element. Most retail investors will panic at the first sign of trouble. You'll see selling on fear, chasing low prices, and using leverage to try to recover losses. This is the behavior that creates cascading effects. Margin calls become snowballs rolling downhill. Prices fall further. Volatility spikes. Banks tighten further. And suddenly, the market that seemed so invincible a month ago becomes a trap that crushes anyone who isn't prepared. Let's break this down into phases. Phase 1, liquidity drain. Forced sales begin, small funds fail, brokers tighten margin requirements. Phase 2, system stress. Banks report losses, regional institutions wobble, and panic starts spreading. Phase 3, retail panic. This is when most people lose control. Margin calls, leverage, and fear combine to accelerate the crisis. Phase 4, institutional advantage. The prepared institutions swoop in, buying the distressed assets at fire sale prices, locking in gains, and leaving retail investors holding the bag. Welcome back. In part 1, we covered the mechanics of the liquidity crisis, why retail investors are the most vulnerable, and how the cracks are forming in the system. Now, it's time to move from analysis to action. If you want to survive and even thrive through this storm, you need a strategy. This isn't speculation. This is about preparing your portfolio, your capital, and your mind for what is coming. First, let's talk cash and liquidity. Ironically, the most valuable asset in this crisis is cash. Not stocks, not crypto, not even gold. But not all cash is equal. You need cash that is immediately accessible. Bank accounts may be frozen during margin calls or redemptions. Brokerages may limit withdrawals in stressed conditions. Keep part of your cash outside the system. Think in terms of cash equivalents, short-term treasury bills, high-quality money market funds, or even a small amount of physical currency. Liquidity is survival, and without it, you are at the mercy of margin calls and forced selling. Second, evaluate your leverage. If you're borrowing to invest, stop. Reduce or eliminate leverage immediately. This is not the time to chase gains. Every leveraged position you hold is a potential death trap. Margin calls will hit without warning, and selling into a falling market will magnify your losses. The first rule of surviving a liquidity crisis is simple. Unleveraged positions are resilient, leveraged positions are fragile. Period. Third, consider asset allocation. Diversification in a liquidity crisis is different from what textbooks teach. You need assets that are liquid, uncorrelated with the failing system, and store value reliably. Historically, these have been precious metals like gold and silver, essential commodities, and real assets like land or income-generating property. Stocks tied to high leverage or consumer sentiment will drop the fastest. Bonds may be temporarily safe, but remember, the bond market is the epicenter of this storm. Prepare for volatility. Now, let's zoom in on signal tracking. The difference between early survivors and late victims is noticing early warnings. Watch the short-term treasury yields closely. If they spike suddenly, it's a red flag. Monitor margin call notifications from your broker. Pay attention to fund redemption reports. Track volume in ETFs and mutual funds. If you see mass withdrawals, that is your cue to assess risk. These are not optional. They are the pulse of the market. Ignore them at your peril. Another early signal, the price of liquidity itself. In a liquidity crunch, borrowing costs rise. Repo rates spike. Overnight lending rates go wild. If you see the cost of cash jumping, the system is under stress. Retail investors rarely notice this until it's too late, but if you understand these indicators, you can anticipate forced selling and protect your positions. Let's talk about psychology. This is where most retail investors fail. When prices drop violently, fear and greed collide. Panic sells happen faster than rational decisions. It's vital that you predefine your exit strategy before the panic hits. Know which assets you will sell, which you will hold, and under what conditions. Treat your portfolio like a machine, not an emotional playground. Your emotions are not your friend during a liquidity crisis. Here's a practical execution checklist for retail investors. 1. Assess all leveraged positions and reduce or exit immediately. Margin calls are the fastest way to destroy wealth. 2. Secure immediate liquidity outside of vulnerable bank accounts. Short-term treasuries and money market funds are your best friends. 3. Diversify into tangible liquid assets. Gold, silver, essential commodities, real estate with positive cash flow. Avoid speculative or highly leveraged investments. 4. Monitor early warning signals, treasury yields, repo rates, ETF redemption volumes, and broker margin notices. Treat spikes as urgent alerts. 5. Define your exit plan psychologically. Know when to sell, know when to hold, and ignore media panic or social pressure. You are not following a trend, you are surviving a system failure. Now, let's discuss why silver and gold matter. These metals are not just stores of value, they are insurance. When liquidity dries up, investors flee to tangible assets. Historically, gold and silver outperform every other asset during currency or systemic crises. They are portable, liquid, and retain intrinsic value. While paper assets collapse under forced sales, metals hold their ground. And yes, in a systemic liquidity crisis, silver's industrial demand adds an extra layer of protection. It is dual purpose, industrial utility and monetary hedge. But owning metals is not enough. You need a strategy for deployment. Watch price levels carefully. Avoid buying impulsively during initial spikes. Liquidity crises are violent but temporary. There will be sharp rebounds and crashes. You want to enter during controlled panic or price dips, not at the top of the first spike. Similarly, when selling, don't aim for the first high. Plan exits based on relative value to other assets, ratios, and long-term positioning. Speaking of ratios, let's discuss the gold to silver ratio, a crucial metric in times of systemic stress. Historically, this ratio compresses during a crisis because silver catches up to gold's monetary premium. Track this ratio as a guide for your exit strategy. When silver is undervalued relative to gold, consider accumulation. When the ratio narrows excessively, it's a signal to lock in gains. Treat this ratio as your GPS through the storm. Another critical factor is timing with macro events. Debt ceiling fights, central bank liquidity operations, geopolitical shocks, these are not background noise. They are triggers for the liquidity phase of the crisis. Stay alert to government announcements, bond auctions, and central bank statements. The early birds who understand the macro triggers will survive. The latecomers will be crushed in margin calls and forced liquidations. Here's the harsh truth. Most retail investors will panic sell. They will do the wrong thing at the wrong time. Every time a bank wobbles, every time an ETF redemptions spike, every time a margin call hits, retail investors lose. The ones who survive are disciplined, unleveraged, and prepared to weather the volatility. Remember, liquidity crises are temporary but brutal. Your survival depends on preparation, patience, and calm execution. And finally, let's look at the endgame. The institutions that survive will acquire assets at fire sale prices. The markets will eventually stabilize, but not before retail investors are hurt disproportionately. You don't have to be a victim. You don't have to ride them at a panic wave into disaster. By staying liquid, reducing leverage, monitoring signals, and holding real assets, you can come out the other side not just intact, but stronger. So here's the final verdict. 2026 is not a normal market year. The liquidity crisis is real, systemic, and will hit retail investors hardest. The early warning signs are visible. Leverage is deadly. Cash is king. Precious metals are insurance. Monitor the signals. Stay disciplined. Avoid emotional trading. And most importantly, don't assume central banks will rescue you this time. The system is stretched to its limit. Retail investors, take a deep breath and take action now. Reduce leverage, secure liquidity, and prepare to ride out the storm. This is a rare event. Most investors will panic. Most will sell at the worst time. You don't have to be one of them. Prepare, observe, and execute with discipline. This is not hype. This is survival strategy for the most dangerous market environment in decades. You have the knowledge. You have the tools. Now it's time to act. Stay calm. Stay unleveraged. Monitor the early warning signals. Hold tangible assets. Protect yourself from forced liquidations. And remember, survival is your first victory. Execution is your second. The market will show no mercy, but you can prepare. The storm is coming. Be ready.